This one option made me over $10,000. Let me show you how. Most people think that options trading is a frantic game of staring at 5-minute charts, chasing the daily hype, and ultimately losing your shirt. But I've been a profitable options trader for 16 years, and some of my biggest and most stress-free wins have come from one particular setup. Let me show you that one. Right here on my screen, you can see that I'm up over 139%, which is more than $10,000 in pure profit on just one single contract. There is no frantic day trading here, no constant screen monitoring, and no guessing. In this video, I'm going to break down the exact strategy behind this trade. I will show you what a leap option is using simple visual models, why I picked this particular Google contract, and the exact mechanics you can use to build up high probability setups without the day trading stress. Before we look at my exact entry price and the numbers, we need to understand this structural tool called the leap option, which stands for long-term equity anticipation security, which is basically a Wall Street way of telling you it's an option with a very long expiration date. Think of standard option contract like a ticking time bomb. If you buy a regular call option that expires in just 30 days, time decay, also known as theta, is your absolute worst enemy. Every single day that you hold it, the option loses value rapidly. It forces you to be exactly right about the stock price almost instantly. Leaps completely flip the script. Like I said, a leap is simply an options contract with an expiration date far into the future, typically 1 to 2 years out. Because you are buying so much time upfront, the immediate daily time decay is practically microscopic. This gives your trade massive structural breathing room. You do not need the stock to explode tomorrow morning. You just need the company to do well over the next year or two. Let us look at the real world math using my actual Google position. Back on October 21st, 2025, I opened this position by purchasing a single Jan 15, 2027 $200 strike price call. My total cost to enter this contract was $7,280. Now, look closely at what the stock was doing the exact day I bought this contract. Google wasn't rallying, it was actually having a down day, opening at $261 and hitting an early afternoon low near about $246.65. This highlights another core rule from my 16 years of trading. Never chase green days. Intentionally, I waited for the intraday pullbacks like this to sweep up my long-term leaps at a massive discount, giving me an optimal entry point right when the short-term traders are panicking. Because I bought the dip in a deep into the money contract, my options premium consists of mostly intrinsic equity value rather than pure time hype. Fast forward to today, as Google recovered, the value of my single contract surged to $17,440 because Google is now at close to around $350 per stock. That leaves me with an unrealized gain of $10,159. So what is the veteran play from here? When you are up 139% on a leap with more than half a year of time remaining, you have crazy amount of options. You can sell it right now to lock in $10,000 cash. I have done this on an Amazon call which I had. I can share more details about that in a different video. You can roll it to a higher strike price to extract your initial capital, or you can use it as collateral to sell short-term weekly calls against it for passive income. So if you're tired of losing your hard-earned premium on short-term options and want to world real-world live examples with clean mathematical models on how to make money, please subscribe to this channel. I have a ton of more information which I want to share with you guys. So until then, look before you leap. I'll see myself out. Thank you.